Hi friends, welcome to the accountancy class. Today we are going to learn about the term accounting ratios. As we know, financial statement analysis is the systematic numerical calculation of the relationship of one financial fact with the other to measure the profitability, operational efficiency, solvency, and growth potential of a business. The analysis serves the interest of shareholders, debenture holders, potential investors, creditors, bankers, journalists, politicians, researchers, stock exchanges, taxation authorities, and economists. The important tools used in financial statement analysis are common size statement, comparative statement, ratio analysis, trend analysis, and cash flow statements. The use of financial analysis is made to ensure the profitability, efficiency, and financial soundness of the business to make comparative study and effective future plans. Now we are going to learn the term ratio analysis. Ratio analysis is a method or process by which the relationship of items or groups of items in the financial statements are computed and presented. It is an important tool of financial analysis. Ratio analysis refers to a technique of analyzing the financial statements by computing various types of ratios. The important financial statements of a company are trial balance, trading and profit and loss account, balance sheet, income and expenditure account, receipts and payments account. These are the important financial statements used in accounting. In simple words, ratio analysis is a process of determining and interpreting the relationship between the items of financial statements to provide a meaningful result of the performance and financial position of a business. Ratio analysis is a study of relationship among various financial factors in a business. The important term used in a ratio analysis is ratio. Ratio is a figure showing the number of times one quantity contains another. It is used to show the relationship between two amounts. A ratio is an arithmetical expression of relationship between two items. When ratios are calculated on the basis of accounting information, they are called accounting ratios. Now we are going to study different types of ratios. Ratios can be classified on the basis of traditional basis and functional basis. Under functional basis, ratios are calculated based on the purpose for which the ratio is computed. The different types of ratios under functional classification are liquidity ratios, solvency ratios, activity or turnover ratios or efficiency ratios, and profitability ratios. Liquidity ratio are calculated to have indications about the short-term solvency of the business. That is, the firm's ability to meet its current obligations. Next is solvency ratios. Solvency of the business is determined by its ability to meet its contractual obligations towards shareholders. For this purpose, solvency ratios are calculated. They are essentially long term in nature. Example, debt equity ratio, equity or shareholders ratio, proprietary ratio, etc. Next is activity or turnover or efficiency ratios. Activity ratios are calculated to measure the efficiency of operation of business based on effective utilization of resources. Example, inventory turnover ratio, account receivable turnover ratio, account payable turnover ratio, and working capital turnover ratios. Last ratio is profitability ratios. These ratios refers to the analysis of profits in relation to sales. Sales means revenue from operations or funds employed in the business, and the ratios calculated to meet this objective are known as profitability ratios. The examples for profitability ratios are gross profit ratio, net profit ratio, etc. Under traditional classification, ratios can be divided into three: income statement ratio, balance sheet ratio, and composite ratio. A ratio of two variables from the income statement is known as income statement ratio. Example, net profit ratio, GP ratio, etc. In case both variables are from balance sheet, it is classified as balance sheet ratios. Example, current ratio, liquid ratio. Next is composite ratio. If a ratio is computed with one variable from income statement and another variable from balance sheet, it is called composite ratio. These are the important types of ratios.